Hey everybody, Rob Maurer here, and today we're going to be talking a little bit about Tesla stock. We have price target increases from both Credit Suisse and Bank of America, pretty significant ones, though of course the stock was down quite a bit today. We also have news on a few other topics, including a possible Tesla AI day, Model Y casting, Tesla's design team in China, and some more news on a possible Apple car. Alright, starting off with the stock, the green run has now thoroughly ended. Of course, Tesla on Friday had closed out its 11th trading day in a row, finishing positive. That record streak is now over. Tesla today finishing down 7.8% to $811.19. That compared to the Nasdaq, which was down 1.25%. Even with the sharp drop today, this is still Tesla's third highest close all time, and through the 6 trading days so far this year, Tesla is up about 15%. The drop today occurred despite 2 significant price target increases on Tesla stock, one from Credit Suisse, one from Bank of America, including a new street high price target from the latter. We'll talk about both notes here briefly. I don't have access to the Bank of America one, so we'll spend a little bit more time on the Credit Suisse note, which I actually thought was pretty well done, one of the better notes on Tesla I've read. They've increased their price target on Tesla from $400 per share to $800 per share, but they have maintained their neutral rating on the stock. One of the big changes here for Credit Suisse, they have expanded their model out to 2030. Under that $800 price target, they are forecasting 5.1 million vehicles delivered in 2030, but they do offer both blue sky and gray sky scenarios, or upside and downside cases. Their blue sky price target has increased from $630 per share all the way up to $1,450 per share, while their gray sky scenario has gone from $240 up to $400. To get to those respective price targets, they are using a probability matrix on what they call their bull and uber bull case, as well as their bear and uber bear case. So while their blue sky price target is $1,450, they actually have an uber bull case with a $2,710 price target, and under that scenario, which again is not their forecast, just an examination of possibilities, they put Tesla's 2030 deliveries at 14.1 million units. In their base case, they're giving Tesla an earnings multiple of 30x in 2030. Because an uber bull case would have much higher growth up to that point, they do also assign a higher multiple in that uber bull case of 40x. On the other hand, in their gray sky scenario, again that's a blend of their uber bear and their bear cases, their uber bear scenario is a $118 price target. That's based on 2.4 million vehicles in 2030, and they also compress the multiple, so they give that a 20x earnings multiple versus the base case again at 30, and the uber bull at 40. On those multiples, and we'll shift back to the base case here, they do talk about how a higher multiple is justified for Tesla because of their involvement in other areas other than just automotive manufacturing. They say, quote, maintaining elevated multiple on base case of 30x give an opportunity for future revenue streams not fully reflected in our model, such as energy, software, robotaxi, insurance, and charging, end quote. So they're basically saying, okay, yes, there may be these other things that we're not accounting for in our model, but we're going to give Tesla a higher multiple to account for some of the value of those things. I'm not sure 30x is high enough. Right now, the S&P 500 trades at 38x. To be fair, that is quite a bit higher than it has been historically. But a relatively stable company that is growing faster than the rest of the index is already going to carry a higher multiple in the first place. And the kind of growth that Credit Suisse is forecasting here, even at that 5.1 million vehicle in 2030 forecast, would already have Tesla's revenue growth rate and earnings per share growth rate well above what the rest of the S&P 500 as a whole would be. Now, this might seem like a minor point, but I'm spending more time on it because it actually has a really significant impact on where the price target ends up. If they just simply changed that 30x forecast to a 50x forecast and held all their numbers the same, all of a sudden that $800 price target is instead a $1,300 price target. Credit Suisse does use that probability matrix blending different scenarios though, so it'd be a little bit more complex than that for their exact price target, but directionally, that's how it would change. Hopefully that example can help illustrate why I am confident that Tesla is still undervalued today even at these valuations. I mean, they've got an $800 price target forecasting 5 million vehicles in 2030 on a 30x earnings multiple. I think both of those are too low, likely by quite a bit. So I don't have any concern about the valuation at these levels, and we'll probably spend a little bit more time talking about that and the reasons behind that in the coming days and weeks. And I guess an important note there, that doesn't have anything to do with the stock price next week or next year. That's just my assessment of where Tesla's business is going to be in 2030, while today's price or next week's price is going to be influenced by tons of other factors that have really nothing to do with 2030. Anyway, as for Credit Suisse's nearer term targets for 2021, they are expecting 853,000 vehicle deliveries from Tesla. And interestingly, they forecast Tesla's year-end production capacity to be 1.44 million vehicles, and then they go on to forecast just 1.1 million vehicle deliveries in 2022. So on that production capacity, they're thinking 150K from both Berlin and Texas each, 550,000 from Shanghai, and then the current 590,000 from Fremont. But then for their 1.1 million deliveries in 2022, they're forecasting both Fremont and Shanghai to be quite a bit below the production capacity. So they're thinking about 300,000 from Fremont and 450,000 from Shanghai. So kind of an odd forecast there that I thought noteworthy. I didn't see much explanation, possible I missed it, but maybe they're forecasting for battery constraints or something other than actual vehicle production capacity constraining Tesla. The final big theme of the note, and this is very similar to what we heard from RBC Capital last week, is that they view Tesla's cost of capital right now as an extreme advantage, justifying some of the higher stock price. They point out how in 2020 Tesla raised $12 billion, which is more than they have raised in their history combined, and that despite that, the stock price has gone up significantly. So the market is rewarding Tesla for having raised capital, which they say that, quote, implies Tesla's cost of capital is negative, end quote. So I think they're saying that a little bit tongue-in-cheek. That's an imprecise way of looking at it because we don't know what the share price would be if Tesla had not raised capital. But certainly it seems to be the case that because Tesla's raised capital, they've de-risked, they now have funding secured, not intentional there, funding secured for future growth, and those things have helped warrant a much higher share price. Basically, they're saying that the market is paying Tesla in the form of a higher share price to raise capital. So again, imprecise, but does make the point, and this is sort of in vogue for these analyst updates. I think we heard similar from Morgan Stanley, from RBC Capital last week, and then if we move on now to the Bank of America note, that was really their theme as well. So Bank of America has increased their price target on Tesla from $500 before, now to a street high $900 per share. They have maintained their neutral rating on the stock. On multiple occasions in this note, they do point to the cost of capital as one of the big reasons for this price target increase, writing, quote, it is important to recognize that the higher the upward spiral of Tesla stock goes, the cheaper capital becomes to fund growth, which is then rewarded by investors with a higher stock price, end quote, and then adding, quote, simply put, Tesla is a new disruptive company that may or may not be dominant in the long term, but that does not matter as long as it can keep funding outsized growth with almost no cost capital driving capacity expansion, end quote. So we talked a lot about this theme last week with the RBC note. That was their big focus, and this point of view is definitely valid. I don't want to understate that importance to Tesla. It is huge, but I also do think this gives a way of analysts to say, you know, we were maybe a little bit wrong, and now Tesla, because the stock price has gone up so high, well, that's now why they're going to be successful. It definitely gives them a convenient out and a way to explain a new tier of price targets, but that's not why Tesla is where it is. It's a part of it, but Tesla was already heading to this new price tier before they raised these last $5 billion rounds in September and December. So I think in a way how this has been presented sort of diminishes all the other fundamental successes in Tesla's business, the rapid expansion, the margin growth, the strong signs of demand, hitting targets, exceeding targets. All that stuff is what got us here, and then the capital raises have piled on. Anyway, I do think it's a little bit interesting that here we're seeing price target increases from Credit Suisse, Bank of America. They're both talking about cost of capital. It does make me wonder if maybe we're on the verge of seeing another capital raise from Tesla. Credit Suisse and Bank of America have both been involved in the last two capital raises, and it's not unprecedented for us to see price target increases the day before capital raises from banks involved in those capital raises. I think that happened with Goldman Sachs the last time. I would also point out that both $5 billion capital raises in September and December were announced on Tuesdays. Right now, Tesla's valuation is about $770 billion, so they could go out and they could raise another $5 billion for about 0.2% dilution. We just got through talking about how those capital raises have seemed to benefit the stock price, so there doesn't seem to be a lot of downside of doing that. I think Tesla's got plenty of capital right now, but if they feel like it's a good time and they feel like they can put that capital to use, I mean, that's such a small amount of dilution to raise a really significant amount of money. I think it would be pretty tough to disagree with that decision. So I don't know, I'm going to watch for it tomorrow. I don't know that we'll see one. I think it might be a little bit too soon from the capital raise in December, and I'm not sure Tesla would do it in between the end of the quarter and an earnings report. I think it would make reporting earnings a little bit confusing since they'd be reporting their year-end cash balance, which would have that capital raise not included. And I'm sure there are ways around that, and at the end of the day, it's not a huge deal. But all else being equal, that would not be the best timing, so we'll see. The other thing that we're definitely going to be keeping an eye on here for this week that I'm a little bit surprised that we haven't heard much about today is the Model S and the Model X. We know that Tesla was scheduled to restart production at Fremont of both of these vehicles today after an 18-day shutdown. A lot of rumors and speculation that that could be for a potential refresh, but as of yet, at least we haven't heard anything one way or the other. All right, next up here, I want to talk a little bit about Tesla AI. Over the weekend, Elon responded to a tweet asking about Project Dojo and the peak performance or the sustained performance, the compute power behind Project Dojo, which, as a reminder, is Tesla's path to automating the training of neural networks and involves them building a supercomputer specifically purpose-built for that task. So Elon replied to a question here saying, quote, maybe a Tesla AI day later this year, end quote. Of course, the last 2 years we have had Autonomy Day, Battery Day, perhaps this year setting up for Tesla's event to be AI Day. I think this is an area of Tesla that everybody does not fully understand yet, myself very much included in that, in terms of the potential this has for Tesla's business down the road, perhaps even extending beyond training neural networks for autonomous driving. Relevant here is another tweet from Elon this evening, replying to one of Salesforce's chief officers, who wrote, quote, artificial intelligence could add $16 trillion to the global economy by 2030. Elon said, quote, much more than this and increasing rapidly, end quote. We were talking about earnings multiples before. Well, I can't think of many lines of business that would carry higher multiples than something like an AI services business. I'd be very excited about an AI day. I think that would be really eye-opening. And at least as we stand right now, I think the sentiment would support something like that where it is much longer term in terms of the vision. Obviously, at the time of Autonomy Day, the market was not ready for that. Battery Day, maybe a little bit more ready for it, but not quite. Though at least the negative reaction there was short-lived. But the market this year is obviously more willing to look further out for Tesla. So the timing could be right. And with any event like this for Tesla, what it comes back to is recruiting. So I think if Elon is mentioning this, that's probably a big part of what he's got in mind. And I'll be actually surprised if we don't end up seeing that this year or maybe early next. All right, next up here, we've got an update on Model Y. I believe for the first time, a single piece rear casting has been spotted on a production vehicle. This is from Twitter user Tony Pham, who took delivery of a Model Y VIN range 97,000 on December 23rd. So of course we've talked a lot about this, but as a reminder, originally the underbody for the Model 3 was stamped pieces rather than cast pieces of metal. So that was 70 different pieces. Tesla with the Model Y took that down to 2 pieces in the rear underbody, saying that would eventually go down to 1 piece. Elon has talked about that on podcasts in the past, and it looks like now Tesla is finally delivering Model Ys with that single piece rear casting. So that should improve efficiencies. As Tesla gets the process ramped up, that should improve volume. And this is obviously a pretty critical part of what Tesla has planned to do in both Berlin and Texas. So nice to see that progress appearing in production vehicles, and probably something we'll hear Elon Musk talk about more on the Q4 call. Finally here, we've got a couple updates on stories from last week. The first is on Tesla's design plans in China. Yesterday, Reuters reported that Tesla is deep in search for a design director for a Chinese design center, saying, quote, the U.S. carmaker's human resources managers, as well as several headhunters, have been trawling the industry over the past 4 months, the sources said, end quote. They're apparently looking for candidates with more than 20 years of experience with multicultural familiarity, particularly with China and the US. Reuters does tie in here speculation about a $25,000 Tesla, which we talked about, of course, on Friday's episode, with Reuters saying, quote, 2 of the sources said one likely China-specific model was a lower-cost volume generator, such as a $25,000 electric car that Musk referred to at a Battery Day event in September, which he said Tesla might aim to bring to market in about 3 years, end quote. So that would seem to further call into question the report that we had from Friday that Tesla had approved a third model for Shanghai, past the Model 3 and the Model Y, in September, and was expecting product verification to be completed in March for a lower cost Tesla. I think we should, of course, continue to remain skeptical of that rumor or that report, but there's not necessarily a conflict between what Reuters is saying here and that report from last week. Again, they just say that 2 of the sources said that one likely China-specific model was that lower cost model. That seems like extremely reasonable speculation, and it also doesn't necessarily tie in any sort of design director to that model. They're just saying, yeah, that's probably going to come from China at some point. Reuters is kind of pairing them in the same article, but the sources themselves do not appear to have done that. It's also possibly worth pointing out that Tesla has actually been hiring design capacity roles in Shanghai for quite a few months now. I think we had first had a report of them listing open positions, design-related positions, back in August. All right, the second continuation here from last week then is an update on the Apple car situation. There's more smoke, I guess, around the Apple and Hyundai rumors. Korea IT News has again come out with another report on this situation, and that has been picked up by Reuters and others. The report says that Hyundai and Apple plan to sign a partnership deal for autonomous electric vehicles by March and start production around 2024 in the US, which is just a little bit more specificity on some of the rumors that we had heard reported on last week. And then there were a few other details that were shared that an updated version of the report actually removed. But the original report said the two companies may be planning to build the cars at Kia Motors factory in Georgia in the US, or to invest in a new factory in the US to produce 100,000 vehicles around 2024. They then say the full annual capacity at whatever this proposed plant ends up being would be 400,000 vehicles. Perhaps the oddest detail here is that, quote, the report also said Hyundai and Apple planned to release a quote-unquote beta version of the Apple cars next year, end quote. I could see them maybe working on producing a prototype next year, but I can't imagine that they would release anything next year. I wouldn't really see the point of that. With Apple's cash pile, certainly they wouldn't need to raise any capital, so not sure on that detail, but in general, again, there seems to be more smoke here. I'm still skeptical that this ends up being an Apple-branded car someday, but definitely worth keeping a close eye on, which we will do. That will do it for today, though. As always, thank you for listening. Don't forget to subscribe and sign up for notifications. You can also find me on Twitter at Tesla Podcast, and I'll see you tomorrow for the January 12th episode of Tesla Daily. Thank you.